You're the Market Sniper. And we're talking general markets, all over markets. I'm afraid I'm still, I think I've become a troll of this David Hunter. Let's hear what he had to say on the current channel that I've just had his work put in front of me again.
And you online? Sure. I do want to just say the Treasury bond market, I think bonds in general have had a nice correction as the Fed tightened. And it looks like they are finding a bottom here, just like the stock market.
So I think the bond market is founding a bottom, just like the stock market. So he's calling bottom on bonds and stocks.
I think the treasuries, if I'm right about this being a top in rates for the cycle, and then a bust coming late this year, early next, or through next year, the treasury long bond, which is got up to 3.25%, can probably drop to 1.5% next year. So, and it won't be a straight line. There'll be ups and downs. But I think you're at the highs in rates, or were recently. 10-year, I think, which got up to.
You're at the high in rates that's just passed in terms of the yield, which was 3.2. We'll show you that chart coming up. There we go. He's calling that the top. And the number we have for the 10-year is 3.2. You can see the high 3.2. Let him finish with his message.
To 316, I think was a high water mark a couple weeks ago. I think that can go all the way down to zero. We may even see negative rates on.
I think that's going to go all the way down to zero, and we may even see negative rates. Okay, so let's go. Let's just go zero hedge for a bit. When will hikes end? So they've started signaling Fed's fund rate. So By the way, this doesn't mean it's right. Bostic makes sense to pause in September depending on economy to see how much damage they've done. The September Fed meeting, which actually means there's two separate opinions that are saying this. This matters a lot because Signorella calculates, they would do 50 basis points increments over the next couple of meetings, continuing an aggressive set of moves. So they would do 3 more half-point moves if their forecast is accurate, which is very unlikely to be. But let's be clear, this is only short term, so they can't be too far wrong. They're awful at forecasting. They'd get anything wrong. You could ask them to guess two numbers between 1 and 2 and they'd get it wrong. But let's just say that they've only got a forecast between now, which is essentially good people June, because May is largely accounted for, and September. So we're talking June, July, August, September. 4 months. Now, you can't be more than a month out when you've only forecasting three or 4 months into the future. So this is kind of small. So Vincent Signorella calculates, if their forecast is accurate, it would imply the next expected 3 half-point rate hikes would be the end of the current tightening. So there would be 3 more half points. 3 more half points. Now, you don't have to be a genius in maths, but you'd have to realize that that's around about 1.5. 3 more half points. That would go on top of the existing rate, which is now 1, which would already take you then to 2.5 on the Fed's rate, which has already traded 3.2. Part of it is pricing in future rate hikes. So this is coming hot off the press. All of them were upping their projections for inflation. So this is the Fed's minutes, what it releases, when it was released. And it came with it came with concern about inflation. Okay, so they're talking about total PCE was expected to be 4.3. It was a lot higher. And we're expecting 3 more rate hikes. Then you get JP Morgan, which is essentially the Fed's bank, their commercial arm. The September Fed meeting, one where we could see a pivot that essentially leaves 3 more CPI prints to prove the case. Now, oil, by the way, still up there, 114 for Brent, 110s for WTI. It is the Rockefeller tax. It is in everything. Bostic, that used to be a glue, by the way, where I grew up. But anyway, also may make sense to pause in September. Many people will call a pivot because they will have then broken it, and they'll wait to see what's broken. But potentially a pause doesn't necessarily mean a reversal. It just means stop doing what you're doing. But given that the system is so sensitive, we've said that there'll be problems. So if you continue to do half-point increases for 3 more months, that's right, 3 more months, going between now and September. If you're pausing September, that means you're going July, my apologies, August, July, and June again. So there's 3 half points. So this guy has said, you've had the top in rates. He's called the top in rates at 3.2, where most opinion, that is only forecasting a couple of inches in front of your nose, is suggesting that there would be 3 more hikes of 1.5%, which would take the treasury rate, which is at 1, already to 2.5. So God knows once that's happened what the 10-year debt should actually be trading at. This is technical. He gives no evidence for this. He just makes the statement. It's not like, I believe. He just says, I believe this is the top in rates. Oh, okay, nice. On what basis do you believe? There is no, because the following. Oh, I just think everyone's too bearish. I'll just take the other side of the trade, just cause. And now's the time to do it. Because everybody's perfectly wrong at this moment, not 2 months' time. And that's just not proof. This is the footprints in the sand. This is the chart. This is where we are. Why did we pause here? As I've covered before, why did we pause at this level? Why did it happen? Utterly predictable, inverted structure, big funnel of resistance here. Let's actually make it a weekly. It's looking sketchy, that chart. Big. Let's get some more real estate as well. We might even need 2 weeks. It still looks sketchy. 2 weeks. A lot of data. You broke and held below the 3 on a consistent basis. This is the whole post GFC. It took the biggest scam of a property bubble crisis to sustainably hold you. So the blue line, just show you, that blue line is the 3%. You did nothing but a stab down twice until the depths of the despair to stimulate that took place roundabout from 2011 to 2012. You couldn't hold below 3 on rates. People didn't want debt that much. It took the dark hours of the post-trauma of the Western economies to sustainably dip and stay under 3%. It took that. You have been in stimulative territory with less than 3%, where it is quite clear that all inflationary measures are substantially higher, even way back in 2012, 2013. Go check what a litre of milk cost you in 2012 versus what it costs you today, or even up until 2020, when no one was talking about inflation. And you'll see exactly what I mean. So we have been in hyper-stimulatory monetary policy. And then, when already at the top end of our range of hyper-stimulatory monetary policy, over here, after being rejected once before, we then shut the entire economy down. There is nothing more deflationary than switching off SMEs, closing restaurants, closing the casinos, closing the pubs, locking everybody down at home, no more evenings out, no more night clubbing, no more catching cabs to go to the theatre, no more anything, no entertainment for the better part of, I don't know how long these lockdowns, 2 weeks to flatten the curve, quickly became 6 months, and that took you to a depression, because this was already a depression, but a revisit to the lows of a supreme macro enforced depression on what recovery you had temporarily had back up to the 3%, which was already in of itself a hyper-stimulatory zone. This entire pink box below this blue line is a hyper-stimulatory zone. You recovered sufficiently with a rising wedge up to there. It's as technical as the day is young that was going to have a throwdown and it was going to be rejected again, and it's there in the goddamn charts. And that zone, that is 2.9, to 3.2 with the key level of 3 in the blue running through it. And that funnel, that was essentially the inverted HVF of rates. That was the entire great financial crisis of 2008, bringing the rates down, down, down into the absolute darkest hour. It wasn't '08 that was the darkest hour, it was the knock-on effects of everybody's reaction and the cancellation of purchases and the job retrenchments that followed, yada, yada, yada. It was '09, 10, and 11 that was so dark, you couldn't, at '09, the peak pessimism of '09, 10, and 11, you couldn't get below 3%. Only subsequently, as a result of QE and hyperstimulation, did you get below 3%. You were unnaturally low. And it took shutting down the entire planet to keep you there, below 3%. This is holding a massive ball stuffed with nitrogen, not oxygen, not air, right down underwater the whole time. And it's not air that wants to pop out. You're talking about something that wants to float in air. That ball just wants to pop up. This is hyperstimulation. This debt, there's too much of it. It's paying shit yields. The inflation has always been significantly higher than 3% in all levels. You've been at it for over a decade and a goddamn half, since 2009. And now you run and you rest at a technical level, and this guy is saying, no, this is your natural place. Not only are you resting here, you're going to go down to 0, which you've never done before. Never done before. So you've had the GFC that took you down to here. You've had essentially shutting down business, except of course Amazon, that did amazing packaging and protected you from COVID with all sorts of things, and your news was there to tell you all about it. Except from those people, you shut down the entire economy. People lost jobs, people that were entrepreneurs, people that were self-employed builders, bricklayers, candlestick makers, taxi drivers, you name it. Their income just ended. Some of them got some stimulus of partial wages at some point for a part of the time. But that was just further currency proliferation, which was debt, more debt, an overwhelming addition of further debt, which is the bond market. So you've got this unbelievable growth in this abundantly supplied shit investment that is totally toxic. And this man is essentially implying that it needs to go to 0 because it is so worthwhile having, it doesn't even you don't even need to pay a yield. And I'm saying he is deluded. The rates has turned. Everyone talks about the 40-year cycle. The rate market has turned. The events that were so supernormal to create that compression on demand, that destruction of demand, on the same scale requires another pandemic, major limitations on supply chain, and a major collapse in all forms of demand by virtue of probably a bank hack, destruction of money, all sorts of things. Not that I'm saying those things can't happen. I still say to you, debt won't go, even if those things were to happen, back down to the legacy levels of around about 0.2, 0.3. He is saying it is going down here. Look at this at a log scale level and understand that this asset category, the game is up for this asset category. You've had your melt up. You had one of the most extreme. Go to the monthly time frames again. How many times I show this chart? And I don't know why. Oh, of course a technical analyst was his put down, would not agree. It's unlikely for them. Where's your proof? Show us something. I am showing something. Where's your proof apart from I believe? I believe. And he's on every show with I believe, I believe. And it's almost like he's pushing his narrative. It's like how he's monetizing. He's going out there and about. He wants to pitch up on everybody's show. We've been calling the end of the debt cycle since the 80s, and it stands to reason. If you're to get a new financial system, the old one must die. The old one is a debt-based system. You need it to die. The debt values must die. The yields must go up. The debt values must die there, and we get to a cancel, stop. They'll never get to they won't allow them to trade 0. They'll call time, stop the clock, and we'll get a whole new world order monetary system introduced to us as a result of this failure. This is a huge rally from around about 0.3s, 0.32s, 0.33s, and traded 3.2. That is a 10x in rates. This is trend-ending event, guys. This is a trend-ending event. And so many people just don't get that. Also, Raoul, who's been pasted on it, and I have some sympathy for him, but he's been absolutely pasted on Twitter for a number of things, is saying buy bonds. Again, buy bonds, wear diamonds. There are so many people that have been trained terminally to be bullish on debt. Buy the damn dip is a meme. It's a 40-year meme. I'll give that to you. It's a 40-year meme, but it is not an investment strategy. Buying the damn dip is absolutely a meme. It is not an investment strategy. It has been a meme for equities and bonds for so long. And you know what? Eventually, the wolf comes. Eventually you cry wolf enough time and the wolf comes. You get less and less space. You've put so much steak meat out there for him, an entire troop of them. I said a troop, a pack of wolves. I was thinking, what's a collection of wolves? Oh, help, a troop of monkeys. Because I got early my monkeypox vaccine to protect me and everyone around me and all my beloved elderlies. No, I didn't, but I'd like to say so. No, I wouldn't. I'm just talking crap because I'm taking the P out of the future pandemic that no doubt we'll all be facing. So there has been a rejection. That is a rejection. Just like that was a rejection. You went into a full-blown spill on a rising wedge. This one is first upside HVF with major overperformance to its first major technical level. Fine, pull back a bit. Let's have a look at that rejection. Is it a violent rejection? Actually, for me, not too violent. It's going kind of low vol, kind of slow, and it's bouncing around in this. It'll probably come off a little more. And guess what I think happens? Mark this YouTube clip. That happens for me. That happens for me. Because you go back to, instead of speculative possible rate increases, into real, just happened, just made it. And they aren't pivoting just yet. They haven't pivoted. And most people's guesstimate on just a 4-month view, because they're going to be totally wrong, everybody's forecasts are wrong, particularly when it involves the Fed, they'll pivot like fools, no doubt about it, and it is coming. Don't get us wrong. We're not saying stimulus won't come back, rate cuts won't come back. We think all those things. You don't get any stock market upside in this environment of such weak demand, such weak consumers, no matter what Powell says about the super strong labor market, in an environment where there's so much uncertainty on supply chain. They're planning their next pandemic and lockdowns and everything else. People have no confidence right now. This is a consumer recession. That is why Amazon is down, Netflix is down. That is why Tesla's even down. That is why so many consumers, including the S&P, which is food and defensive, even they are down. People do eat less in depressions and recessions. They eat less, they order less, they have less new TVs, they buy less stuff. Their credit card bill's just getting a whole bunch more expensive. Their mortgage payment is just getting a whole bunch more expensive. They need a refinance and they're looking at the new rates, which is going to be a whole bunch more expensive. And they're going to get to release less equity, which will be their savings expenditure for the next few months for a new car. All of that is getting more expensive. And in that environment, stocks do not go up. Stocks go up in the expectation of Fed action in cutting rates and stimulus. And at the moment, not my best guess, the best guess of the Bank of the Fed and others in there is that you have 3 more half-point rate hikes. Let's say they're wrong. Let's say there's only 2 more and we go a break. You're still going to add another full percent to the Fed fund rate, which is at 1, and we traded 3.2 on the 10-year. What will the 10-year be when the Fed fund rate is not a guessed number, but is a hard 2 with a possible third? Let's say that third never happens. So just predicting 2 more rate hikes, you're going to have a full extra percent on your Fed fund rate at 2%. What do you think the 10-year bond will be? Well, it traded 3.2 on expectations. It's having a little bit of a pullback. So is the dollar. Did you see what the dollar has done in such a short time? Dollar slightly back, bond slightly back. But for how long? You call that a reversal? He's called it a reversal. I've called it a continuation pattern. I do technical analysis. He doesn't. He says, I'm calling a top, believe me. That's my opinion. No evidence. I have nothing to attack. There is no evidence for why it should be a top. He's saying a top because the Fed will do a turn. We know they're going to do a turn, but they're not turning tomorrow. They're not turning tomorrow if that's their Fed meeting minutes where they're all hawkish as hell and chasing inflation. They're not turning tomorrow. Anyway, no doubt you'll appear on a few more shows and get everyone in equities absolutely wrecked, buying the 50% pump in 6 months while the Federal Reserve is still pursuing tightening in one of the most fragile retail recession economies that has ever existed. Going into summer, when the summer months are usually very, very soft, go away in May, come back in St. Leger's Day, you're going to get, during this summer, a 50% pump in 6 months. Boy, oh boy, that is an unbelievable statement to make. And of course it was a 50% pump back in January when he was first talking about this idea that never came, and now it's just been delayed, just been delayed, just been delayed. We'll just keep moving our theory forward and we'll refuse the feedback the market is giving us as being truth. We just keep being wrong and extend the time zone, keep being wrong, extending the time zone. We'll not look at the feedback. We don't look at charts. That is absolute monkey wizardry for fools. Okay, good luck. We'll see you on the other side, guys. As far as I'm concerned, this is very, very dangerous. Stock market is in trouble. You've already had, oh, by the way, since our first recording, which was designed to, again, save people from pursuing the pump that is alleged to be coming, the SPY has, that is the Standard Poor, not the tech index as you would imagine, but the SPY, the Standard & Poor's index, has already made virtually, I don't know if it's actually made, it might have missed by a pubic hair, a head and shoulder target to the downside, and we expect more. So this is not it. But one of the head and shoulders that all his followers said, that's not a head and shoulders, has already performed. That break has run to there. If you want to call it, I don't know how fat my line is, how exact this is. I've drawn it freehand. It's quite a fat line. This should be a little higher. I don't want to make it work, but there's a bit of a gap there on that. It's made target. But that's not important because we're quite confident in our technical view that despite any rallies here, and you are getting bounces, as you are getting the pullback on the yields and you're getting the pullback on the dollar, that it will in time go lower and make it more definitive. And there's a long way to go still for the NASDAQ to make its target, which is of course a much higher beta version, and that is also why we are continuing to be conservative and biased to the short side on crypto as well. And then there's the Dow, which has come also exceedingly close to making targets and continues to have spike rallies, new low, spike rally, new low, and you've had a low there, you've had a low there, you've had a low there, and we're expecting further downside. If these markets cannot go up on a short period of dollar weakness, when will they go up? Because the dollar strength is the fear trade. The dollar strength is the fear trade. You've had a pullback now after touching technically the 105 level by a smidgen. What's the ultimate high? Hold it there. 105.0005. That is literally typical of key levels of significance this run. A pullback period here. It could go for a little bit more. I expect again continuation. Look at that debt markets continuation. Also, whilst you're getting a little bit of a spiky rally in the high yield debt, this has triggered, and it's continued to be a warning signal. This is the first time you're having any kind of buoyant rally This is triggered and has been in a sustained sell. Watch this. It's a higher beta version and it can turn too. Okay, guys, that's it. Minor relief spike in the high yield debt. Dollar having a pause, and the 10-year yield, in our opinion, having just a pause for now. So watch it. I think this falling wedge sees a bump back up. Be very, very cautionary about chasing into equity longs, risk on longs, on someone that's continued to make the call from January, February, March, April, May, June, July, in an environment where the dollar's got stronger, the fear trade has been dominant, the Fed has been tightening, the bond rates have been going up, and the bond market itself, TLT, has been going down, down, down. This is a deflating asset class, guys. This is a deflating asset class. And let me tell you, every time RAL goes long, it's usually at a key point. He's just released, and I'm a fan, by the way. I'm not trying to make someone a fool or be mean or anything of that. What he's achieved with his the business success, etc., etc. But he is positive. He's always positive, and it's always the exponential everything. And unfortunately, there's an old system that still has to die. On the one hand, something has to die. The debt system has to die for the new system. And the 3 times he's tweeted bond death is buy bonds, wear diamonds, was here as the head and shoulders triggered, and now in this rally. And that for me is a rising wedge for further down to the side to the 89. We were called lunatics. This traded 179. We said it was going to go to the 135 and then to 89. That was a key turning point, inverted HVF. That target has been made. At the same time, a head and shoulders has triggered. It's gone lower. You now have a rally, and all the same people buy the debt markets. Buy the debt markets. Do not buy the debt markets at end of cycle. This is a 40-year bull market that is coming to an end for the whole exponential everything, and the metaverse, and the central bank digital tokens, and all of this amazing new wizardry that will be your surveillance finance realm to come into play. The old horse must die for the new horse to take over. You need to shuffle the inertia of the old boomers still straddle their old lovable horse that farts and lumbers on. They've got to make it properly lame. They've got to put a bullet in its head to get him off. And that means death of the debt system. And for me, this TLT remains a short. And it's something that's been a short there, it's been a short on the right shoulder, it's been a short on the triggering event, and it will be an opening short. Now, that's not me advising you. You need to know where to put a stop. It could rally a little more. If you aren't aware how to do that, we have themarketsniper.com. Book a call and a chat, and you can see how we enter trades, how we engineer high risk to reward trades. But it's my opinion that you will be getting exactly that coming soon. Let's have a look at that rising wedge a little bit closer and see. Oh, it's such a beautiful wedge. I'm going to take that orange square off. Look at this 3 impulse wedge. Absolutely beautiful. Absolutely beautiful, my precious Market Sniper friends. If you haven't hit the puppy licks button right now, please do it. We need popular demand. We need you to say you're having a great time, you would want more content from the Market Sniper. You do that by hitting the puppy licks button. That is a rising wedge, just like the yields were a falling one. That is a rising wedge. It's a beautiful 3 impulse rising wedge. It goes something like this. Kind of got a bit of complexity there. And now you're going here, and you've got a grindy little squeezy Japanesey right there on your splitter in a rising wedge. By the way, you can just stick your head out like that and then come back down and break down. You can rarely, but not often, have a type 3, which is a pop out the top and just run, in which case we're entirely wrong. But in most instances, the long-term expectation is a break to the downside. This is a rising wedge on the TLT to be shorted, in my personal opinion. And it will slowly come, you'll slowly see some semblance of dollar strength and Eurozone weakness again. And you should continue to see weakness in the Asian currency crisis. Watch out by these moon callers into 3 further half-point rate hikes on equities. Oh my God. I don't know what more to say. I feel frustrated. I feel frustrated. Wasting our sweetness on the desert air. Have a great weekend coming forward. Come on, the Liverpool boys against Real Madrid this weekend. Give me a puppy licks if you want to see the red men come on out on top. Book a call. By the way, reset is the big game. Boy, are we getting lots of demand. People that want to be in communities. They are interested in new build homes. They want to have foundations. They want to be protected. They want to pay less tax. They want to do so legally. They want to have separate entities. They want to protect places where you can keep bullion safe, all sorts of elements outside of just trading for wealth. It's not only what you make, it's what you get to keep from the prying eyes and hands of an overreaching state in totalitarian Bolshevik times. You need a talk. Catch us on themarketsniper.com, book a call, costs nothing, we charge you nothing. Sincere people that want to make real changes in their lives are all welcome. We'll catch you next time. Thanks for watching.